If you want to understand the state of the American economy and labor market, look no further than the June jobs report. It captures the paradoxical moment we find ourselves in, a cooling but still hot job market that confounds easy narratives. On the surface, the headline numbers look discouraging. Job growth of 206,000 is respectable but lower than expected. The unemployment rate ticked up to 4.1%, the highest since late 2021, and revisions shaved over 100,000 jobs off previous months' totals. This follows other recent data showing job openings declining sharply and unemployment claims rising steadily if still historically low. The great job workers imbalance that defined the post-pandemic economy does seem to be easing. So is this the long-awaited pivot to a cooler labor market and the Goldilocks slowdown the Federal Reserve has been trying to engineer? A moderation in job gains taking heat off wage growth and inflation without causing a severe recession and spike in unemployment? Not so fast. Look closer at the June numbers and a more complicated, almost paradoxical picture emerges. Despite slower job creation, the labor force swelled as over 350,000 people entered or re-entered the job market. The labor force participation rate rose significantly, hitting a over two-decade high of 83.7% for workers in their prime years. This is the holy grail of a hot job market, people being pulled in off the sidelines, expanding the potential labor pool and productive capacity of the economy. It's evidence that the lure of plentiful jobs and rising wages is still powerful for Americans on the sidelines. Strikingly, over 3/4 of June's job gains came in relatively low-wage sectors like healthcare, hospitality, and government work. This is not your typical late-cycle hiring binge concentrated in volatile sectors like construction, manufacturing, and temporary help services. In fact, those economically sensitive areas continued shedding jobs last month. So here's the paradox. By some key measures, the job market is cooling, causing the unemployed to have an easier time finding work. Yet it still seems more than hot enough to draw hundreds of thousands of Americans back into the labor force, lured by plentiful openings and rising wages. This split personality is evident in the conflicting signals on wage growth. On one hand, average hourly earnings grew 3.9% over the past year, the slowest annual pace in 3 years as the jobs boom moderates. That's welcome news for inflation fighters. But dig deeper and you see wages accelerating from month to month. For non-supervisory workers, hourly earnings ticked up 0.4% from May, twice the increase for all workers. This is consistent with a tight market intensifying upward pressure on blue-collar wages specifically. What explains the murky, almost contradictory picture from June's report? How can we square slowdowns in hiring and overall wage growth with an apparent red-hot labor market drawing people in and forcing up pay for the rank and file? The best explanation is that it reflects an economy transitioning between two states. We are leaving the red-hot phase defined by severe labor shortages and breakneck pandemic recovery. But we have not yet reached the cooled-off era the Fed hopes to manufacture through interest rate hikes. Instead, we seem stuck in an awkward, unsustainable in-between lukewarm phase. Enough lingering heat to keep spurring labor force growth and wage pressures, but not the sizzling, inflationary heat of a year or two ago. Making sense of the June numbers requires a further distinction between two different kinds of inflation pressure: demand pull and cost push. The Fed's preferred strategy for taming inflation focuses on the demand side. By hiking rates aggressively, the central bank can throttle back consumer and business demand enough to cool excessive spending and price growth. Ideally, this would happen without unleashing severe harm on the supply side of the economy. Labor force participation would stabilize at robust levels, and companies could hire enough workers to operate at an efficient, non-inflationary pace. That seems to be what the June report hints at: a cooling of breakneck consumer and business spending allowing the labor force to catch up. Fewer total jobs being added, but steady labor supply growth and moderation of economy-wide wage pressures. The risk is that the supply side fails to cooperate, a key possibility driving up cost-push inflation that may prove impervious to Fed rate hikes. Think about what's happening in the lowest wage sectors like restaurants, hotels, and healthcare driving June's job gains. These industries were ravaged by the pandemic and continue struggling to lure back millions of workers who left. AWOL employees enjoyed pandemic relief checks, then found better opportunities elsewhere when reopening created millions of job openings. If this labor crunch persists, it could unleash a self-sustaining cycle of wage price spiral unlike the 1970s. Desperate employers forced to steadily hike wages to attract scarce workers, then passing those labor cost increases onto consumers in the form of permanently higher prices. So while demand pull inflation is subsiding under the Fed's rate hikes, stubborn cost-push inflation in labor-starved sectors could become entrenched. This all sets the stage for the Fed's upcoming July meeting and policy decision. The June jobs report looks certain to keep them hiking rates, despite growing angst over a possible unnecessarily harsh economic slowdown. Any relief on the inflation front seems mostly demand-driven so far, with pesky and potentially persistent labor cost inflation still lurking. The Fed will keep tightening until it's convinced core services inflation excluding rent is firmly under control. But policymakers must watch carefully for signals the supply side of the labor market and economy is genuinely healing, not just demand throttling back. An extended stall in job growth could morph into rising unemployment if firms find themselves overstaffed. A steady increase in labor force participation would provide reassurance, allowing the Fed to move to the inflation-controlling sidelines. So the June jobs report offers a paradox, evidence of a cooling in the hot labor market, but still uncomfortably hot wage pressures that could become entrenched absent a steady labor supply rebound. How this plays out will determine if the Fed can choreograph the elusive soft economic landing or is forced to induce a harsher recession to defeat inflation. As always in our messy and complicated world, the truth exists in transcending the false choice between rosily optimistic and darkly pessimistic narratives. The June numbers capture an in-between transition state that is neither terrible nor terrific, but fraught with paradoxical tensions we'll be grappling with for months to come. For financial professionals and ordinary Americans alike closely watching the economy's zigs and zags, last month's employment situation embodies the supreme paradox with stark clarity. A cooling but still hot job market, just hot enough to draw in more labor supply but not so scorching inflation will be easily broken. A lukewarm reality balanced on a knife's edge, poised to swing either toward a soft landing or something more sinister. We find ourselves in those unsatisfying, undecided, in-between times that try our souls and demand both hope and patience. When this transitional jobs report is the prologue, the main story still awaits our collective authorship.